continuing our topic of budgets, in this part we're going to look at the preparation of a cash budget. So I will have a fully worked example for you, but we're just going to look at some of the components and the steps in preparing a cash budget in this video. So as we've already spoken about, all types of firms are likely to prepare a cash budget, and that's because cash is such an integral part of running our business. Now just make a note that a cash budget is not the same as a cash flow statement. The cash flow statement we did in topic 6. A cash flow statement tells us what money has actually come in and what money has actually gone out. It's an external report of actual past transactions. So remember, with a budget is we're forecasting what's going to happen or what we think may happen in the future. So cash budget is prepared for the use of internal managers of the firms, and it lists the estimated receipts for a period and the estimated payments for a period. It then shows the estimated bank balance at the end of that period. Okay, so we work out what we think we're going to receive in cash, the estimated payments that are going to go out. Then we take the receipts minus the payments, gives us either an increase or decrease in cash for that accounting period. Then we add that to the cash period we started with, and right at the very bottom we have the estimated bank balance at the end of that period. And you'll see that in the example video. Now, cash budgets are only concerned with cash in and cash out for a particular period in time. Therefore, things that aren't cash, so non-cash items such as depreciation, provision for doubtful debts, are not included. Okay, so what we want to drill down to are just the cash coming in and the cash going out for that particular period in time. And we include all cash in and cash out regardless of what it's for. So it doesn't matter whether it's we're buying an asset or paying for an expense. Okay, it doesn't matter, it's included if it's cash going out, and all sources of cash coming in, so sales, interest received, rent received, etc. It doesn't matter where the cash is coming from, we include it in the cash budget. So we're looking for all estimated cash in and all estimated cash out. Now there are a number of steps in preparing the cash budget. So what I'm going to do in this video is go through the first couple of steps. Now you may like to go from this video to the lecture, to the topic example, okay, but what I'm going to do is explain all the content, and then the last video, part 7, will be the example, a full example of a cash budget. Okay, so what are the steps involved in preparing a cash budget? The firms follow these steps in preparing a cash budget. First of all, they assess all expected trading conditions, assess all expected trading conditions and gather all necessary information. They prepare the initial budget estimates and communicate with the manager. So these parts 1 and 2 are usually done by the staff, okay, in conjunction with their departmental manager. Okay, and they can communicate that upwards. So remember I said that we often build a budget from the bottom of the firm up to senior management. 3, that we prepare a schedule of receipts from debtors or accounts receivable, and the totals from here are used in step 4. Step 4 is we combine all the information that we have to prepare a cash budget. For this course, steps 1 and 2 will have been done. So I don't expect you to be able to make the estimates. We will be presented with the required data, And what you have to do in this course is focus on 3 and 4. So use the data that you're given to prepare a schedule of receipts from debtors / accounts receivable and the cash budget itself. Okay, now an important component of preparing the budget is doing the schedule of receipts from debtors. And the main challenge in preparing a cash budget relates to this calculation. So if you remember back to when we did business transactions, we saw that firms may purchase and sell for cash or on credit. If we consider sales, okay, if a cash sale is made in January, this leads to a cash receipt in January. Okay, so if a customer comes in, pays cash, and it's January, we make the sale in January and we get the cash in January. If a credit sale is made in January, when is the cash received? It's really hard to know. The only thing we know for sure is, or for certain, is that cash is not received at the time of the sale. So what we have to do is estimate when the cash will be received when we're dealing with credit sales. So to do this, firms analyse the way that debtors typically pay their accounts and use this to estimate when the receipt from a credit sale will occur. And you will always be given this analysis. So for example, the question will say, or the example will say, in the past, credit customers, accounts receivable or debtors have paid their accounts as follows. Okay, and it will be some sort of analysis. So as an example, 60% will pay in the month following the sale, 30% in the next month, and 10% in the following month. Okay, so to explain this out a little bit further, we would expect, if credit sales for August were $1,000, then we would expect to receive nothing in August, okay, because the first 60% comes in the month following the sale. So the month following the sale is September. So 60% of $1,000, so $600 is expected in September. Okay, the next month is October. 30% or 0.30 of $1,000 will be collected or is expected to be collected in October. So that is $300 and $100 in November. So the last 10%, 0.10 of $1,000 will be collected in November. Okay. All right. You will see that process happening in the topic example. Okay, so I'm just giving you the bones of it. Once we organise the information, then we place it into the cash budget. Okay, so this is the first step. Then we would go through our list of payments that we expect to make and put that in the payment side of the cash budget. Okay, so that's the end of this topic. The next topic will look at how we analyse